Nortam's posted higher half-year output, supported by smoother operations and higher productivity. The groups posted a 3.7% rise in platinum group metals production, while chrome output jumped nearly 15%. Now, the biggest gains came from its Eland mine, where operations continued to ramp up. Northam's added that output at its Zondereinde mine also improved, supported by a shift into higher quality ore areas and improved logistics. Overall, the company says the performance reflects higher productivity and stable operations across its mines. BP and Sasol are eyeing a sharp increase in fuel storage tariffs, citing a sustained drop in petrol and diesel demand. Official data shows fuel consumption is down by nearly 6 billion litres since 2015 as hybrid work and higher prices curb driving. The companies are seeking a 105% increase in fees at their Pretoria fuel facility, saying lower volumes have hurt site economics. They've also warned that diesel demand from Eskom is likely to ease further as the power grid stabilizes. Labat has renewed its cautionary announcement. That's as discussions continue with an artificial intelligence and technology company operating in the Southern African region. Labat first flagged the possible deal in late December, noting it could have a material impact on its share price if concluded. Shareholders have been advised to continue exercising caution until further details are announced. South African listed property delivered a standout performance in 2025, helped by improving operating conditions and the return of dividend growth. According to the SA REIT Association, the sector delivered a total return of nearly 39% last year, building on a strong performance in 2024. The recovery was broad-based, with several major property groups recording solid advances. And while capital growth may slow this year, the association says income growth remains supportive, with dividends expected to rise steadily as interest rates ease and fundamentals continue to improve. Further afield, China reported a record trade surplus of nearly $1.2 trillion in 2025, led by booming exports to non-US markets. This as producers looked to build global scale to fend off sustained pressure from the Trump administration. Here's more detail.
China posted a record trade surplus of almost $1.2 trillion in 2025. Chinese policymakers' push to diversify beyond the US paid off as exports to non-US markets boomed. Producers have tried to build global scale and fight off trade pressure from the Trump administration. They have shifted focus to Southeast Asia, Africa and Latin America, and that helped cushion the economy against US tariffs and tensions with Washington. There will be more challenges for Beijing heading into this year. That as global capitals have grown more worried about China's trade practices and overcapacity. But a customs official announced Wednesday that China's foreign trade remains solid. They added its ability to deal with risks has been significantly enhanced. Its December exports grew 6.6% year-on-year, beating forecasts and up from November's number. Imports were up 5.7%. Economists expect China to continue gaining global market share this year, bolstered by Chinese firms setting up overseas production hubs to combat US and EU tariffs, as well as strong demand for lower-grade chips and other electronics. But Beijing still faces further questions about how long it can counteract a property slump and weak domestic demand by shipping cheap goods to other markets.